So yeah, I want to welcome everybody. I welcome you and thank you for joining us tonight. This is our 14th Michigan Investor Group meeting. And I'm just really glad to see a lot of your faces and names. And of course, you know, miss being in person, but in some ways this helps us get more reach. A lot of people who were on this call tonight wouldn't be able to be here in person. So I guess we'll look at the positives, right? So tonight we're going to be talking again about one of my favorite topics, or some of my favorite topics. And, you know, we're going to be talking about investing in a fund of mobile home parks and self-storage facilities. So basically a rundown of our agenda this evening. I'm going to give you a brief overview of our next MIG meeting, and then I'll tell you a little bit about how I got to know Mark, our presenter tonight, and give you a short, brief bio about Mark and his background. And then I have a little announcement to make, and then Mark will share with us for probably 20 minutes or so about the fund that we're going to be discussing tonight. Then we'll have Q&A, question and answer period, for as long as folks want to hang out. We'll do that, and then just have a short closing. And my goal is that 8 o'clock will be done, unless people want to hang out and keep the question and answer session going. But 8 o'clock is the goal for being all wrapped up. So March 24th, we're going to have a return guest. Some of you might have attended our last in-person MIG meeting, where Bob Burnett came and talked about cryptocurrency. Well, that was right before things pretty much took off crazy in the crypto world. So Bob made some statements that I think a lot of us didn't believe, and who knows why, but a lot of those things came to fruition. And so Bob's coming back, and I think he's an excellent presenter with a whole lot of knowledge and background in the crypto space. So March 24th, we'll be getting back together to have Bob join us. So in 2017, somebody that I respected a lot, said, hey, maybe you should look at this mobile home park fund. And before that, I probably hadn't thought about mobile home parks too much, at least from an investment standpoint. But I took that person's advice, and then that kind of, how when you invest in something, your antennas kind of start picking things up a little more. And that's what happened. I decided to kind of look more at the space. And when I started researching the mobile home park space, I saw somebody on LinkedIn who posted a couple of articles, and that man was Mark Khuri. And so that was back in 2018. And Mark was kind enough to just talk with me and share with me his background and experience and knowledge of the space. And I really didn't have any knowledge or background or experience in the mobile home park space then. And Mark was one of the first people that took his time to share with me and talk with me. And then we've kind of kept in touch over the years. I've been getting Mark's, twice a year or so kind of investor newsletters and announcements when he has another offering. We haven't done business together until more recently, but sure have appreciated, just staying in touch. And then, so that's how I met Mark. And then we decided to actually start working together. And so kind of the announcement that I want to share tonight is that this is going to be the first MIG meeting where I'm actually part of the deal, you would say. Our first 13 MIG meetings have been educational, and a lot of people that me and my family have invested with have come and presented, and tonight's going to be a little different. And I just want to make sure that I bring that out clearly and let you know that I'm actually partnering with Mark, our presenter, to raise money for this new fund that Mark's going to talk about. So Mark and his father have a lot of experience working together in real estate and other investing arenas. And since 2005 or 6, Mark has been running SMK Capital Management. Mark lives in Bend, Oregon, and he's married, and he has two young children. And his background, basically the last 15 years or so, has been real estate investing. And he's actually one of the people that I know who has the longest time of experience in the mobile home park space. Since about 2009, I believe, Mark has been investing in the mobile home park arena. And he's also invested in multifamily and retail and other sectors, including some hands-on, kind of getting his hands dirty, direct ownership of real estate as well. But so basically, with no further ado, I'd like to introduce Mark and ask him to share with us about the Mobile Home Park and Self-Storage Fund.
Yeah, thanks, Dave. Thanks, everybody, for coming on. Can you all hear me okay? Yes, I got some thumbs up. All right. Yeah, I appreciate the time today. I'll add a couple thoughts too. You know, getting to know David over the last few years it's been great. You guys probably know as well. He's just a sound guy, very honest, very down to earth. He tells it like he sees it. I appreciate that. There's a lot of fluff in the industry these days, and so he's a straight shooter. And we think alike when it comes to investment strategy on a lot of different fronts. One thing that I was attracted to, David, too, is you put together that mobile home park. It's more of like a thesis paper or a research paper, I don't know, 50 pages long, diving into the asset class, the merits. And I just thought that was great, to do that, call it for fun, right? I was excited about that. And so we've geeked out on a lot of these things together, and I'm happy to be here today and have David join us in a front that we're already kind of doing separately and now together. So quick intro there, but we'll dive in, guys. Bear with me for a second. I'm just going to share my screen, and I hope it works well. We'll find out here in a second. Everyone see that okay?
Yes.
Perfect. So, I'm happy to share with you kind of an overview here today, guys, about our alternative income fund, which combines our favorite asset classes today, mobile homes and self-storage, into one investment. Before we begin, a quick disclaimer here. All investments involve risk. You should consult your attorney, financial advisor, or accountant to understand the risks prior to considering an investment. And this presentation is not an offer to sell or the solicitation of an offer to buy any security, which can only be made through the offering documents that contain the details about the risks associated with an investment. So any investment details contained herein are believed to be reliable, but we make no representations or warranties as to the accuracy of such information and accept no liability therefore. Thank you for bearing with me through that. Let's go ahead and start. Okay. There we go. So yeah, I'm happy to share an overview today, guys. We have recently launched our alternative income fund. Again, it combines both mobile homes and self-storage into one investment. I know a lot of you on the call today are aware through research and through personal investments of the merits of each asset class. But we're at a very interesting point here in time where through history, we've learned by seeing how different asset classes perform in different market cycles. But we've got 2020 behind us, and we have almost 4 quarters of data and performance to analyze through a global pandemic and recession. And we can use this data to really best determine where to invest going forward. So in short, what we've learned through the pandemic thus far is that both of these asset classes, mobile homes and self-storage, remain highly attractive to residents and to investors. They've performed quite resiliently, not perfectly, but definitely resiliently. And we believe that they have the highest likelihood of continuing to perform well over the next decade. So we've combined the two together into a fund, and let's go ahead and dive into the details. Okay, so our fund's main objective is to spread capital across multiple assets, regions, and operating partners, and to provide investors access to a highly diversified portfolio of cash flowing mobile home parks and self-storage facilities with a value add upside potential. So some of the key investment benefits, we are a professionally managed fund focusing on capital preservation and downside protection. We are combining lowly correlated recession-resistant asset classes into a portfolio for passive accredited investors. We're diversifying across multiple asset types, regions, operators, and properties. We're targeting assets that are generating current income and the opportunity for appreciation and growth. We're focusing on a very attractive risk-adjusted return and wealth creation with a superior hedge against inflation, favorable tax benefits, including accelerated depreciation. And we are an experienced management team with the relationships to access and select high-quality deal flow. So let's review just the structure of our fund. We've got 2 class shares for investors. Let me just have this all load up here real quick. Okay. Class A has a minimum investment of $250K and a preferred return of 8%, a split above that of 80% to investors. And we're projecting an average cash-on-cash return from rental income of 9 to 11% for Class A and 8 to 10% for Class B. And we have an equity multiple of 1.8 to 2.0x and a projected average annual return of 13 to 18%. That is from the cash flow from rents and from the property sale profits. Our fund has an asset management fee of 1.25% and an acquisition and disposition fee the same. Our investment term is 5 to 10 years. We do anticipate that in this fund structure, some of the properties will begin to start seeing refinancing and sales a little earlier, years 4 and 5. Sorry, say again? Oh, okay, I'll keep going. In years 4 and 5, we anticipate some of the underlying assets will have some capital events and return of principal to investors will begin then. We will be doing distributions quarterly, and you can see the cash flow ramping up each year in the first couple years as the value add measures of the underlying parks and storage facilities take place. Okay. So I know I'm talking to a group that is pretty well versed in mobile home parks. So I'm not going to read everything on the screen here. Our executive summary has a lot of detail. But some of the benefits, why invest in mobile homes? And, there's a very unique business model, low expense ratios, which often result in higher profit margins. A lot of the residents own their own home, which reduces CapEx. We'll talk a lot more about. We're seeing an increasing demand overall for affordable housing. That's been a trend we've been following for many years now. And I don't think that's going anywhere. I think it's continuing to grow. Limited supply of mobile homes due often to zoning regulations, another favorable advantage of the asset class. And then tax benefits, 15-year depreciation schedule on the land improvements. And then market inefficiencies, we'll talk more about these in a minute, but a lot of mobile home park owners are mom and pop owned, not necessarily, maybe not be capturing the full value of the potential of that property. And so these are some of the benefits of mobile homes. Let's shift over to self-storage. Why do we like self-storage? So storage is quite unique in different ways. You have long-term tenants on average. Not many people think about this, but average tenant duration about 14 months, and 46% of tenants stay 1 to 10 years. And so that is something we like to see and often a little bit misunderstood because you have short-term rental contracts, typically month to month. And so what you end up seeing here is that you have the ability to adjust rental income up and down with pretty short notice, 30 days as needed. And it allows for the potential to increase revenue and also maintain or possibly even offer concessions if you need to in a potential downturn. Storage has a very solid track record through multiple market cycles, and it's been one of the top performing assets through COVID in 2020. And another benefit is the low overhead business model, pretty self-explanatory, but very relatively easy to maintain without utilities, for example, electric, gas, plumbing to each unit, generally speaking. Okay. Let's review some of the data and trends on each asset class. So mobile home communities and self-storage facilities, as I mentioned earlier, they're highly fragmented asset classes, which are primarily owned by individual investors. And many of these owners aren't capturing the full potential of their asset. And that provides an opportunity where you can own and operate the properties with a bit of a more professional strategy, focusing on bottom line revenue growth. In addition, there's a growing opportunity to aggregate properties and portfolios and potentially sell at a premium to institutional players who are really seeking scale. And so what you'll see here, mobile home communities, again, about 85% of mobile homes are owned by individuals. And for self-storage, roughly 73%. Now, these alternative sectors, they're continuing to become more and more mainstream, as we would say, and more institutional investors are getting attracted to them. So, for example, Blackstone, the largest private equity and alternative investment firm in the world, began investing in mobile homes in 2018 and invested another $550 million, as you can see here, again in September of 2020. And in October, Bill Gates and the Sovereign Wealth Fund of Singapore acquired a stake in StorageMart, which is one of the largest self-storage operators in the country. And again, these two acquisitions happened in the middle of the pandemic. So it really shows the growing demand for both asset classes. And we believe this trend is only going to grow over the next decade. COVID has really made investors realize how crucial it is to increase diversification within their portfolios and to allocate capital into assets that have remained largely resilient through economic cycles. Another advantage worth noting, we touched on this earlier, but both asset classes have attractive low capex that often results in higher profit margins. I won't dive too far here, but you can just see the comparison to apartments. If you think about when a tenant moves out of an apartment, you typically have to reinvest back into that unit, paint, carpet, etc. In storage, you can mop it, sweep it, and have it re-rented in an hour in theory. So in mobile homes, a lot of the residents own their homes and they tend to stay very long term. So we love this as an advantage when compared amongst other asset classes. Okay, let's talk about Sam Zell. Billionaire Sam Zell, his equity lifestyle properties is the largest owner of mobile home lots in the US. And I just love this chart. It shows in orange how their portfolio has maintained positive net operating income growth in all quarters since 1998, even through recessions. So just a really great example of this affordable housing option's resilience through economic downturns. And here we're looking at mobile home park rental rates and occupancy trends. This goes back to 2007. So you can see how the asset class performed through the Great Recession. And it's really just very consistent, which is what we love. The rental income growth is up and to the right as of the last 5 to 10 years. And it really, we see as long as you're being fair to the residents, the turnover is extremely low. There's some prohibitive reasoning for folks to move a home. It's quite expensive, and so that also helps, but just a great chart to show the resilience of this asset class. Another kind of self-explanatory, this is on storage. This is the percent of the US population that uses self-storage, goes back to the 1980s. And so just a lot of consistent history and trends for both of our asset classes. All right, let's quickly shift. I want to talk about, how have these asset classes done through COVID? And self-storage is important to note that this asset class experienced significant new construction, which resulted in a lot of markets suffering from oversupply. And this trend is something we've been tracking for quite some time, as it's had a negative impact on overall performance. So what you see, though, is that the future looks bright. In blue, you'll note that self-storage new construction has slowed as of 2018, looks like when we peaked. And vacancy rates are at the lowest level on record. That's the orange line you can see that goes out through, this is Q3 2020. So we just believe that the tailwinds are great at storage at the moment. And some of the concerns we've had with the asset class in previous years may be behind us. We'll see. So we're excited about this. Now, one of our selected operating partners invests in both asset class. They acquire and oversee both mobile homes and self-storage. So what we have here is the portfolio performance through 2020, through Q3 of 2020. And what you'll see on the left is that rent collections. The blue line is manufactured housing, mobile homes, and the red line is self-storage. Just very consistent, even through the peak unemployment months, April, May. We didn't see much volatility here. And on the right chart, same kind of general response here. The occupancy consistent and actually increased through COVID. So really good example of an actual private portfolio. Okay. So, looking ahead, through 2020, mobile homes have experienced rapid valuation growth, actually #1 across these 11 asset classes here. You can see 12% growth in the past 12 months. This was released in January 2021. So it's really important, it shows the resilience and the perseverance of our asset classes through, unprecedented times. And self-storage, very, very stable. And now if you look at malls, retail, office, lodging, as a comparison, they've really suffered. And I'd say we think that the future is quite uncertain today, to say the least. All right, let's take a look forward. So this is, again, projections, right? We like to see how things have done and where we think they're going. But in September of 2020, Green Street Advisors published their projections of returns here for the next 5 years across 10 real estate asset classes. And mobile homes have the highest projected 5-year expected returns, and self-storage top 3 as well. Okay, so we've already identified the first few investments for our fund, and I want to review them with you today. This first targeted investment is into a portfolio that is expected to grow to about 95 million of equity. And what you'll see here is one of the assets that was acquired in December in this portfolio is a self-storage facility. It's in Missoula, Montana. It's got a occupancy rate of over 90%. And really fits into our thesis. It's a mom and pop owned for 20 years. There's some operational inefficiencies, below market rents, some unnecessary expenses, deferred maintenance, et cetera. So that's part of the value add plan, is to come in and improve the net operating income. Another photo here. And then we've got the highlights and projections. You can see the going in cap rate of over 8.5%, very attractive. Cash on cash, equity multiples. Again, it was sourced off market. And we have a projected hold period of 4 years on this property. So if that actually comes to fruition and the property is sold in year 4, investors would get a portion of their invested capital returned to them with, of course, profits from the sale. All right, this next targeted investment consists of 2 mobile home communities that were just recently acquired in Wisconsin. So the total number of lots is 177. One of the parks is 90% occupied and the other is 70. And it's our operating partner's 8th mobile home park investment in Wisconsin. So the plan here is to bring on a veteran regional management team that's going to oversee the property and has also had a successful track record in the local community. And they've identified the value creation plan primarily at this portfolio is to increase occupancy at the community that is 70% occupied. And you'll see the projections here. And again, this has a attractive rates of return projections, but also a hold period of 5 years. And so if the property is, again, sold in 5 years, investors would get a portion of their principal back and profits. All right, this next targeted investment is into a portfolio of mobile home parks. And this portfolio is projected to grow to over 50 million in value. The 4 communities that are currently in the portfolio include 469 lots, and they're over 92% occupied. This is in the upstate New York region. Our operating partners here focus on the upstate New York region. They currently own and operate 26 mobile home communities there with over 2,000 lots. They've been founded in 1997 and are amongst the top 50 largest mobile home park owners in the US. And let's take a look at the projections here. So great cash on cash returns, equity multiple, very attractive projected returns. Now this portfolio has a projected hold period of about 10 years, although we do anticipate there's going to be refinancing events probably in years 4 and 5, which will return a portion of investor principal once the value add plan has been completed. Now, we're touching quickly on our operating partners, and I want to dive a little bit more into that. They are one of our most critical aspects to success. Their role is to acquire the property, execute on the business plan. And we focus primarily on partnering with operators that have established teams, both in the back office and on the ground, that can handle day-to-day operations. We tend to prefer vertically integrated firms that have in-house property and asset management. It allows us to often capitalize on their economic efficiencies. And we also focus on selecting operating partners that have stellar track records, many through multiple market cycles. We do require them to co-invest into every deal personally, and a lot of them have over 100 million in assets under management. So let's look at an example of one of our operating partners targeted for our fund. So our operating partners here currently have over 150 million in assets under management. They are a vertically integrated firm with over 30 internal and property management staff. The founder and CEO began acquiring mobile homes and self-storage for his own personal portfolio in 2006. And they focus on both mobile homes and self-storage. And you can see a quick snapshot here. They have a portfolio of over 8,000 units across 12 states. And so this is one of the profiles of our operating partner targeted for our fund. Same operating partner, this is their current portfolio. It's a bit hard to see on the screen, but a couple of things to point out. They have a pretty conservative loan to cost of 65% across the portfolio, a loan to value of 51%. And then you can see the debt service coverage ratio is about 2.5x, which means that the portfolio creates enough operating income to cover the property debt payments 2.5 times over. So we like that conservative approach to debt, something we pay close attention to. And here we'll see that this is a list of their realized investments that have sold. How do they do, right? So the focus that they've done primarily is on what we would consider to be lower cost assets, typically less than 5 million, really going after mom and pop owners. And they tend to have shorter investment term period, shorter being, call it around 5 years or so. And you can see their ability to drive value time and time again with the IRRs here. They're far often exceeding projections, which is something we love to see, of course. Okay, let's look at a really exciting property that the same operating partner just sold in January. This was a 311 lot mobile home community in Louisville, Kentucky. And they were just able to create a considerable amount of value at this park in a really short period of time. When they acquired it, they immediately placed one of their experienced management teams here, and they executed on a lot of NOI growth, in part by putting in place a water submetering project. This is all through 2020, by the way. And you'll see the performance here. I just want to say, historical performance is not indicative of future results, but just such a great case study nonetheless. So they bought it in February of 2020 for $7 million and sold it in January of 2021 for $15 million. So just outstanding returns in a short period of time. And again, this is really primarily due to driving NOI. They grew it, from 457,000 to 688,000 in about 10 months.
Hey, Mark, just a quick question.
Sure.
Who buy? I mean, so that's a short turnaround. Who buys that a year later for the significant price increase? Is it more of an institutional type of thing that sees the stabilized cash flows and is willing to accept a lower rate of return?
Yeah, there was that portion of it that was attractive to the next buyer, but also there was still a lot of meat left on the bone. They had not completed all of the value add strategy at that park, and it was an unsolicited offer. They weren't trying to sell. They got a knock on the door and said, "I want to buy this," and they gave him a price he couldn't refuse. So that's kind of how it played out. David actually said this quite well just a couple weeks ago to me. He said, whenever there's a buyer, there's a seller, right? And so there's pros and cons to selling this property, and there's pros and cons to buying it. And I guess it's kind of like, stock market. You want to sell a stock when you think no one's could possibly be interested in buying it.
I'll speak to that deal real quickly. I submitted an offer on that property as well.
Oh,
and I'll
great.
just tell you that buyer massively overpaid for that market. It makes no sense.
Yeah,
but that's fine.
So it's like it's the bigger idiot theory.
I mean, that's what we're seeing a lot in this space right now. They bought it right, and there wasn't really much to do to flip it in a year. So in less than a year, but they weren't the only groups to see it, but that Louisville it's got a lot of supply. So, we'll see how that turns out for the buyer, but I'm glad it worked out for Mark and his team and the operating partner.
All right. Thanks for that.
No problem, guys. Yeah. Well, let's keep going. We're going to review some of the pros and cons of investing in a fund versus direct with an operator. I won't go through everything here, but overall, the big main benefit is lower risk. By spreading capital across many properties, if one performs below projections or two, it may be offset by others that could outperform projections. And so we like that demographic, and we've been focusing on diversification for over 10 years. And by investing in multiple properties, regions, operators, strategies within properties, you really can spread and reduce overall risk. Next, by aggregating capital, we have the potential to earn more favorable terms. And our strategy also allows investors to access deals that may have high individual minimums. And we also consolidate K1s and provide, one point of contact for communication and updates, which, leading to the cons or the negatives, could also be a negative depending on how you look at it, right? But another potential drawback is that we, as a fund manager, we do charge a fee, although we focus on, making our management profits highly dependent on the performance of the fund. Another potential downfall of our structure is that funds are often blind or semi-blind. And what we mean by that is that none or only some of the assets may actually be identified at the time of investment. And so essentially, the fund manager has the authority to select investments without investor approval or even after investors invest as the portfolio continues to grow. Okay. So just to summarize here, guys, our alternative income fund is designed to provide passive accredited investors access to professionally managed fund. It's designed to provide diversification, cash flow, and growth through what we believe are today's top asset classes. We're only planning to accept investor capital for about the next 30 days or so. We've already targeted several of the assets for the fund, and we're accepting capital on a first come, first served basis. So, if you're interested, you can reach out to David or myself. Our information's here on the screen. Happy to share more details along with the offering documents, next steps, answer any questions, and go from there. So appreciate the time. I will maybe remove the screen share here now, and then we can open it up to Q&A.
Hey, Mark, thank you.
Sure.
Just a couple of things. Mark, could you tell us a little bit about maybe the number of operators you're thinking that we're gonna, place capital with, and maybe a little bit about the differences of the operators? Maybe they're just, like we discussed, they have a little different perspectives and maybe strategies.
Yeah, absolutely. So we have 8 operating partners targeted for our fund. And it'll depend, obviously, who and what we invest in. It depends on ebb and flow of their deals, right? How much opportunity are they able to share with us that we can participate and invest in? As far as, what some of their focuses are, I'll give you just examples. One operating partner, they do a lot of heavy lifting. So they are a heavy value add mobile home park operator, and they'll come in, not much cash flow in year one, which by itself, we probably wouldn't invest with them. But when you add it to a different operating partner that focuses primarily on cash flow and not much value add, it really creates a very stable and consistent income stream. So we like that. And so those are the pros and cons, where there is no perfect operating partner, guys. They just, no offense, I know there's a few on the call today, but we like to see the pros and cons of all of them, because there's a lot of benefits to what one group might do that another is not doing, and vice versa. And so maybe that helps answer the question, David, but by grouping them together, you can reduce risk, and you can also see that, again, if you have higher cash flow in the earlier years from one operator and less from the other, they might have a more value on the later years. And so we like that blend.
Okay. And, if people choose to invest with us, like, how quickly do you think the fund will be investing with the actual operators?
Yeah, good question. So we are just kind of the mindset, which might be different than other fund managers, but we don't just create a fund and then go find the deals. It's the other way around, right? And so why did we create this fund is because we see several deals that we like right now. And so again, by putting them together and creating that blended overall return, that's what we're doing. And so we already have a few operators targeted, as we went through quickly on the slides. I just got off the phone with a call with another operator yesterday. They're on the road for the next 2 weeks. They are just about to get a park under contract in Greenville, South Carolina. Rents are at about $450 a month, which includes lot and house rent. And the market rent for a 3-bedroom apartment is $1,200 a month. And so, it's just hard to beat. And they're looking at, it's 154 lots, if I recall, and about a $4 million purchase price. So about $26K a lot with homes on it. And they've already got experience in that market. And so we'll see, right? They're doing it as we speak. If it comes to fruition, we like the numbers, we like the opportunity, and we think it's a good fit for the fund, we might add that to it as well. But we're just constantly looking at deals, guys, and trying to pick the best.
Okay, we have some questions submitted on our chat. So I'll ask a couple of those, and maybe we'll go through these, and then people, please, when there's a break in the action, please feel free to, chime in and speak up if you'd like to. But I think you kind of answered this. When does the subscription period begin and end? Now it begins, or maybe last week it kind of began. And then we're hoping like the end of March. We're thinking it'll be like kind of like the month of March.
Yeah, that's about right, David. We already started accepting investor capital. And so, again, it's a closed-end fund. We're not planning to keep it open for too long. We've identified a few properties and few opportunities that we think are going to work really well together. And so, we plan to close it in about 30 days or so. We'll see. If this operator with the Greenville property, we like the deal and we like it, and he needs an extra week or two, are we going to close it early and not invest in it? No, we'll probably keep it open for another week or two to do that.
Okay. We had a question about the investment minimum of 50,000. They're asking if they can come in lower than that.
Yeah, David, we are okay with that. It's I totally get it. And so for new relationships, new investors, we're flexible. And so that's not a problem.
Okay. Can you tell us about your kind of how you vet the operators that you.
Sure. Yeah. Geez, it never ends, let me tell you. But basically what we often do is we will, let me see where to begin, but almost all of our operators come to us from either referrals from other investors that have invested with them and believe in them and have done well with them. A lot of times we'll test them with our own money, make an investment directly, see how they do, how do they communicate, are they transparent? And then there's just a lot of questions and answers, right? And it takes time, David. I mean, I'm just thinking of an example, but we've vetted a mobile home park operator for 2 years and we still haven't invested with them. And so we have kind of like 3 buckets, I'll say, and this is for all of our asset classes. We have a yes bucket, we will invest with these operators. We have a maybe bucket and we have a no bucket. And the yes bucket is about 12 to 15 operators today. The no bucket is about 24 or so. And the maybe bucket is about 36. And so it's just always happening, right? There's always information coming in. You can reassess. Some of the things we look for is, kind of a niche that they're in. They have an expertise in one thing. They're really good at it. They've done it very well numerous times, and it's a rinse and repeat model. I like boring. Like, hey, we just did this 5 times. It worked every time. Here's why we can do it again. That's great. That's a great story to have, right? So we like that. Experience is extremely valuable, especially today. We're at a peak of a market cycle. We're at a peak of asset pricing. Margins are squeezed, cap rates are low. And so the market trends are not in inexperienced operators' favor. You got to be buying right and you got to be operating right. And so we pay more attention today than maybe 5-7 years ago on experience, David. And so that's really important for us. And, transparency, communication, I mentioned those, but they're so important. I'll tell you right now, I've been underwriting an operator, I won't say what space or whatever, for about 8-9 months. And they're now in the no bucket because of lack of communication, poor communication. That's it. Everything else seems to be there. But at the end of the day, if you're not able to consistently, and I ask a lot of questions, so I get it. I might be a pain to some of these folks, and that's okay. That's my job. But at the same time, if they're not open to sharing when they're courting us, right, call it that, then what happens if something isn't going right at the property or the asset, right? And I need a lot more communication. So we look for folks that are available and they're readily available and they're transparent and they tell it like it is. And that's a big part of it. So I think in summary, it's part science and it's part art, and you got to blend it, and it's a never ending process for us.
Hey, Mark, when did you first invest in a mobile home park? Like, can you tell us that, like the story of that first one?
Yeah, for me, it was in Frank and Dave's fund in 2012, AHCF2. And so that was in 2012. I'd been researching the asset class for a number of years, David, because so personally and my family, we owned primarily residential and multifamily active holdings through the recession. And we saw how they performed, which was overall pretty good, depending on location. But by 2009, it was like, what else is out there? What do we think we can see in a lot more protection in the event of, the world was falling apart around us at that time. And I just went on a kind of a 2-year networking binge in Los Angeles at the time where I was living, met a lot of real savvy people, and this is pre-Jobs Act, right? So you couldn't find investments online per se. You had to go and shake hands and listen to people talk and actually get to know them in person. And I did that, met a lot of savvy folks, and the mobile home park space became just more and more intriguing to me as an investor. I was looking to diversify my own money through my 401k. I, now self-employed a few years, didn't have matching from my job, my corporate job, excuse me. And so I was trying to find a place to invest those dollars. And you can't put them in your own deals. I didn't know that at first. It's a prohibited transaction. So avoided that and started investing passively with operators in mobile homes and self-storage. And so learned a little bit by just what we all are doing, right? And side by side. So
okay. Thank you. We had a question here. They're asking, since we have a management fee involved in this, there's a question about if we need to have a Series 65 registered investment advisor as part of this team. Can you speak to that?
Yeah, it's a common question, David. The answer is no. We are exempt from registration under Section 506C for this offering, which allows us to accept capital and manage funds from investors without being a registered advisor. Accredited investors, I should be specific, yeah. Gotcha.
Okay, you've already talked about due diligence process. Can you tell us about an example of when you were in due diligence with an operator and you're saw a huge red flag and had to walk away?
Oh yeah, let me tell you a story. And this is, I'm trying to be a bit diplomatically correct here. But essentially, this is a repeat operating partner that my family and myself and our company had invested with numerous times in the self-storage space. And we're doing more and more diligence. And part of diligence when you invest with a firm is tracking how things are going in your investment versus what was projected. That's a big part of it, right? Not just upfront, you do your homework and then you invest and then you forget it and don't do anything else. So we're constantly analyzing NOI. How is it looking compared to projections? We're looking at rent growth. We're looking at the overall business plan, the strategy. Are they on time? Are they on budget? Whatever the specific plan was for that asset. And so long story short, we started seeing that rent growth, increasing rents at self-storage was lagging projections, right? We were projecting 8 to 12% annually, which 5 years ago was somewhat normal, I would say, generally speaking, depending on where the asset was located. And I basically questioned the operator and said, I'd like to see your portfolio performance, rent growth, actuals for the last 2 years. What have you actually been able to do? And it took some time to actually get them to send it to me. But what I found when I opened it up was, long story short, there was one property at the bottom that we call an outlier. It had 147% written in there. And the rest of them was 2, 3, 7. And so if you remove the outlier, you find that the average was 3%.
Wow.
And the fact that they went and put that in there, and it was in a different font. So it just stuck out we're making stuff up, is what that basically told me. And I said, all right, we're done. And we have not invested with them since. It's been 4 years.
Okay. I got this really persistent person who said I missed a question. His name might be Mike Shirky. So his question was, I'm getting these texts hey, you missed my question. He wanted you to explain your comment about, I think you were talking about one of the parks that had a refinance event, or maybe it had a sale in year 5, and you said a return a portion of invested capital. Could you maybe just explain that again or further?
Sure. Yeah, so in a fund structure, you have a partial ownership interest in multiple properties. So let's just say it's 20 properties across both asset classes. And let's say you invested 100K, right? You're going to have, and let's assume that it's spread evenly, just for normal projection measures. It's 5K per property, right? So if one of the properties sells, then a portion of your capital, right, the 5K of the 100K would come back. That's what the portion means. I don't know if that helps answer the question.
Yep. Thank you. Thank you. Another question. So there's a lot of demand. I mean, some people might not realize this, but there's a lot of demand not only to buy the parts, but there's also demand from passive investors to invest with operators. So what are you and I doing? Why do operators deal with you and I as of raising a fund?
Yeah, good question.
That was my question, by the way.
Oh, okay.
Because you two yahoos, I got to understand why they would want to invest in you two yahoos.
Yeah, what do they care about us for, right? Yeah. So good question. And I'll say this, there's some advantages to the operating partner for having a managed fund invest in their deal. And I'm sure there's folks on this call that can answer to it directly from the other seat, right, as the operator. But essentially what we're doing is we're making it easier for them. They have one source of contact for our whole investment pool of capital and investors. One K1, one quarterly statement, one update, one person to deal with, and that's me. But at the end of the day, we're trying to make it easy for them, and they know what we are looking for. And so a lot of times if they do need equity or do need capital, they want to have a partner that's trustworthy, that's reliable, that understands what they're doing, and we get it. And when they have a deal, they'll come to us and say, look, we can raise X, but we need a little help with Y, right? And are you guys interested? And so that's a lot of it, how it works. It's a relationship, it's a partnership, got to help each other. And it has to be a win-win. Otherwise, and I'll say that for people who are looking to go out and maybe do this on their own, and you've got to find operators that typically will appreciate what you're doing. Not everyone does, and so that might not be a good fit. But that's kind of how we look at it. It's got to be a win-win.
Okay. We had a question here about, besides us raising money in this fund and being a capital allocator, do we have any other role with the mobile home park and self-storage operators directly?
Yeah, I mean, generally speaking, I'll just say that operations, day-to-day business decisions, we are giving up that control to our operators on purpose. And so regarding that stuff, it's best to assume we don't. At the same time, we've been doing this for quite some time. We know a lot of people. And so if we see something that we think could be helpful or something to watch out for in the industry, we'll share that with our operators, right? We want to help them as much as we can. And they might make decisions based on, some information that we have, maybe they don't know yet, or whatever it might be, to help impact everyone's bottom line, right? And to perform better. That's the goal. So with that being said, at the same time, I'm sure there's people on here that will appreciate the need for some operators to provide more transparency and actual data and communication on their monthly or quarterly updates as to how are things really going. And that's important to me. We pay a lot of attention to performance throughout the investment. And so that's something that is an added level of communication that we provide to our investors, which requires our time to go digging into what is actually going on at the asset level, on the ground. And I've seen all sorts of different updates and performance over the years, guys. And I'll just tell you, it's sometimes easy to mask a problem. And that's exactly what I'm looking for. I want to make sure if there's a problem, we find it as much as we can. And we want to know exactly what's going on. How are we going to fix it and when? And that's important to me. And so if something starts going left in a business plan and we're supposed to go right, I'm increasing communication. I'm on the phone, I'm on a call. Sometimes we visit in person. I haven't been able to travel that much with COVID, but go see what's happening and make sure they have it under control or not, and then see if we need to step in and do anything to help them. But that's typically an added layer that's a benefit for the investor, where and I get it as a passive investor, like I don't, just to be perfectly honest, I don't track my own investments quite as closely as I might, 25, 50K investment into a passive deal each quarter as I might if I'm managing investors' capital. And so it's an added duty that I take very seriously and try and pay a lot of attention to the detail. And if an operator is short on their communication and what they're sharing with us, then we're going to get on the phone and I'm going to ask 100 questions and I'm going to provide a lot more detail as to what we really think's going on.
I'd like to add a couple of things there. As I was kind of sort of interviewing Mark in the last couple of months, like he's been interviewing me, whether to kind of partner up or not. He sent me some of the SMK investor reports that he sends to people who invest in the funds. And this was a 2018 vintage recession-resistant fund that has mobile home parks, self-storage, and apartment buildings. And I'm not trying to say that I know everything, but I get a lot of quarterly and annually reports from the different people that we invest in. And it was clear that Mark added, and Mark must have gotten on the phone and talked to these operators to add some color and some detail to the summaries that the operators were sending out. And so I think that is, and then I don't want to get into too much detail, but it just happens to be, I invested in a self-storage fund in 2017 with someone that Mark knows, and Mark had a similar fund, and there was an asset that recently, basically Mark and another fund manager, I mean, I don't want to speak too bluntly, but they basically got the operator to sell it. And we're going to get our money back, not going to make any profit on that, but I think they saw it as this thing hasn't been working out too well, way behind on the value add components of that self-storage facility. And so, I mean, he won't say this because he's very humble, but basically they pretty much, I shouldn't say forced, but influenced the operator to sell it. And so that was kind of interesting to see that happen just by chance at the same time that we were kind of dating in this relationship. Okay, no more about dating. Let's move on from that. Okay, we had a question about fees and splits. So there's a acquisition fee, and there's a one-time acquisition fee, and there's a annual management fee, and there's a disposition fee. So all these fees, what are all these fees?
Sure. Yeah, it's pretty standard in fund management. How do we make money? And we're transparent about it. But an acquisition fee is when we deploy capital and we invest into a deal. However much we're investing is charged a fee, 1.25%. So it's not based on asset value or property cost. It's just how much we're investing in it. So think about a whole fund. If it's $2 million, 1.25% of $2 million. A disposition fee, same thing. If we have a property that's being sold or refinanced throughout the 10-year window, call it, however much money we're giving back to investors, there's a fee. It's a time in the life cycle of a fund where there's just more work for us. And so it helps compensate us for that time. Asset management fee annually is a 1.25%, and that's for us to manage the fund. And that's also based on capital raised in the fund. And so really the incentive for us though, guys, is the splits above the preferred return. That's where we make our money. And so if the fund isn't doing well, or even that example you just gave, David, of that self-storage facility, we pushed to get out of that deal early. I made less money by doing that, right? But it was in my investors' best interest to do so, and that's why we did it. And so I hope that helps with the fee structure.
And then as far as the question about splits, and when the person asked about splits, they're asking if the fund meets the preferred return for the limited partners. So there's going to be a Class A and a Class B shareholder class, and the Class B, if you invest $50,000, if the fund pays over a 7% annualized preferred return, then the limited partners get 70% of the profits above and beyond that 7%. And then if you invest 250,000 or more, you're in the Class A. And if the fund pays more than an 8% preferred return, then you participate in 80% of the profits above and beyond that point. That's the term splits.
That's right.
Okay. What are the signals or metrics you recommend tracking if we see when it comes to looking at a sector that's attractive or not? I guess a sector or asset class, I guess that would be.
That's a great question. So, and I always try and take things in context, like today, right? Because 5 years ago was different. 5 years from now might be different. So today we want to see tailwinds, meaning more demand growth for our asset classes from users who pay the rent and from investors who are your exit, who are you going to sell to? Are there going to be more of them or less of them in the next 3, 7, 10 years? Now, we don't know, right? Nobody knows, but there's enough data out there where you can make a pretty good guess. And that's kind of what I would say. So look at the tailwinds and try and decide, risk and reward, right? This is part of it. So let's look at an example of maybe an office building in an urban center today. Hard to trade on that right now, right? Not a lot of buyers looking for that. But there might be some opportunistic buyers that are saying, look, we can get it really cheap and we can ride it out 5, 10 years, it'll be full again, whatever the thesis might be. And you might be comfortable with that as an investor. But what's the risk and what's the reward, right? So are you going to get 30% return for taking all that extra risk? 40%? What is it? And what's the risk of loss? What's the risk of no return? And so, there's always a balance of risk and reward. You want to look at that pretty closely by comparing a lot of different deals, operators, asset classes, and try and find we look for a sweet spot. We want to have the lowest amount of risk with the highest amount of return, of course. But how do you do that? And so within asset classes, there's strategies too. And that's kind of the second layer. We're not looking at acquiring too much that doesn't have what we would say stabilized occupancy at acquisition. 70, 80% occupied is about as low as we typically want to go when we buy it. We want it to cash flow day one if we do nothing to it at all except operate it how it's already been operated. And we want to have a value add plan where we can grow the net operating income. We're not relying on speculative market appreciation. We need to go in, pull some levers, do some things to increase revenue, reduce expenses, and increase the value of the property manually. And so that's probably a bit long-winded in answer, but you have asset classes, and then you have strategies within those asset classes to help get what we think is a really great risk-adjusted return.
Okay, thank you, Mark.
Sure.
We got a question. Who are the operators that we're actually going to invest with?
Yeah, so I'm happy to share that, guys. Just to be perfectly open and honest, it's a lot of work to figure out who we're going to select to work with. It takes years, just to be honest. And we just ask folks to connect with us directly to share that one-on-one rather than share with everybody. I hope that's okay, but trying to protect some of those relationships and interests as much as possible. But there's 8 of them targeted for this fund, as I mentioned, and we have a list that we can share with folks directly. And happy to talk to you about who and why, one-on-one.
So this wasn't asked, but I think this is a good follow-on. Again, I'm just asking as if I was an investor on the call. So, I mean, has the SMK Alternative Income Fund, have we negotiated like lower fees from the operators? Have we negotiated higher preferred returns or higher splits, or are we going to get more bang for our aggregated dollar? What's happening there?
Yeah. Good question. So sometimes we do, not always, just to be transparent. There's pros and cons to that whole subject. And I can talk a lot about it because I do it every single day, right? This is what I'm focusing on is, does the deal make sense? And terms are, of course, part of that analysis. I will say this, there's 2 operators at least in our fund that are targeted for our fund, that one of them has a $5 million minimum just to get in. And although we don't anticipate investing that much with one operator, just through relationship, we've been able to negotiate that down so that we can probably get in if we choose to do so. Another operator has different levels of splits, preferred return to our fund and split above the preferred return to our fund based on how much we invest with them. And so we plan, this is one of the target operators, we plan to invest at least 500,000 with them, maybe $1 million, to be able to get higher terms and better terms for our fund. And I can keep going, David, but there's a lot of operators out there, and there's pros and cons to finding those that need money.
Yeah.
And I could talk a lot about that versus those that don't need your money. And there isn't one size that fits all. We've worked with operators that need money, that are doing really well, and those that aren't doing very well. And we've worked with operators that don't need money because they can send an email and they can fill up the deal in 48 hours because they've been doing it for 20 years and they have a great investor base and an awesome track record. So should you be focused on just what's the terms? Am I getting a better split? Am I getting a better pref? Those are all projections. You can do whatever you want with projections, right? At the end of the day, if you have the right people and you have the right net income and net return to investors, then you're probably in a good balance. And so pros and cons to needing and not needing capital.
Gotcha. Okay. How about reporting? What should, if some of our guests here choose to invest with us, what should they expect in terms of frequency of updates, reporting, newsletters?
Sure. So we, as long as everything's going according to plan, we'll do quarterly updates. If things aren't going according to plan, we do more frequent updates. Quarterly updates provide, an overview of performance, financials. How are we doing? Cash flow, returns, etc. Are we above projections, at projections, or below projections? And if we're below, why and how are we going to get them back up? And if we are looking at the business plan side, which is more text and verbiage and story, typically there's a value add play at most everything we're doing. So we want to track that and see how's it going. There'll be an additional piece of information about the business plan. Are we hitting our numbers, hitting our timeline, our projections there as well? Are we seeing, units getting leased up, et cetera, et cetera? So it's a combination of numbers and text, I would say. We do them quarterly. And for me, we spend a lot of time on that, David. I try, because I'm an analyst by trade, so I ask a ton of questions. And if I send out a quarterly update to our investors, I always think of myself as the investor receiving it. Is this clear? Are there questions that I didn't cover? And if the answer is, no, I think we did a good job, we'll send it. And I'll tell you, but by kind of putting my investor shoes on and my investor hat on in that process, what I've found over the years is a lot of our investors don't ask a lot of questions. And I'm proud of that. It's because I think, at least, that we're providing them enough information where they're getting those answered if we had not otherwise done so, So I think that's how I would approach it. And so we do them quarterly unless there's a need to increase them as well.
Okay. What's the kind of the target for capital raise here for?
Yeah, so right now we have, I would say, hard commitments of $1 million, another 1.3 of soft commitments. And so just be conservative. It's my nature, we'll say 1 to 2 million for the total fund. If it goes above that, great. But I think we'll be able to achieve the diversification where we sit today based on the hard commitments alone.
Okay. If you had to put a proportion of the portfolio based on dollar, that'll be mobile home park versus self-storage.
Yeah, great question. So where we sit today, I think it's going to be 2/3 mobile homes and 1/3 storage, give or take, of course. We don't know, David, so I'll say that too, but we are leaning towards more mobile homes than storage.
And What's the first thing you think of that makes you just want to keep deploying capital into mobile home parks?
Oh man, the first thing. I just don't know if there's a better asset class for the risk reward appetite that we have as investors. I just don't think there is. You know, we love apartments, still do apartments. In 2018, we did, as you mentioned, we put together our recession resistant fund, and we included workforce Class B apartments with high occupancy at acquisition in growth markets that are still affordable, very specific. And that hasn't changed. But today, that's really hard to find that actually pencils a good return.
Yeah.
And so we didn't include it in this fund on purpose because I don't want to tell people, hey, we're going to have apartments in here too, and then we can't go find any. So instead, when we get a good apartment deal, we'll just, you know, put that together in a one-off deal. And so I think that's important to know, but I just don't think mobile homes can be beat at this point without taking on more risk.
I'm going to call on a couple of our guests here and ask that same question. Bryce Robertson, what makes you want to keep buying more mobile home parks?
Okay, g'day guys, can you hear me?
Yep.
Beautiful. Yeah, so, you know, mobile home parks are super hot right now, and, you know, we've got waiting lists, so we haven't seen anything less than 15 people on a waiting list at any given park. So, yeah, I mean, we're just seeing demand so high right now from tenants, because, I mean, if you really think about it, around about a third, arguably about a third of the population in America has a need for affordable housing. Yet really there's only 45,000 or 44,000 mobile home parks nationwide. And there's actually a 1% decline in inventory each year because they're closing more parks than they're actually developing them. So, when you look at the availability of affordable housing, mobile home parks is the biggest contributor to affordable housing. And when I say affordable housing, I mean living costs or housing costs of under $700 a month. And so we're seeing, you know, around about like $500 a month or $600 a month is the average in the mobile home park space right now. So we literally can't keep up with it. We can't fill lots, buy homes, and remodel homes quick enough to keep up with the demand. So it's off the hook right now, and it's a really cool place to be, given all of these things that are happening in the economy and with coronavirus and everything like that. It's cool to be able to contribute and help people and improve that sector of housing in America.
Thank you, Bryce. That was kind of off the cuff. I hope you guys don't mind. I want to ask Joel Mazer that same question. Joel, why do you want to buy another mobile home park?
Yeah, I mean, I have to say, I come at it from a totally different angle. I actually just enjoy the business. I find that it is one of the few asset classes that can really fill a double bottom line mission. So in that sense, if you're familiar with that term, you know, it's one thing to make money, but it's another thing to do good. And so a lot of my time is actually trying to do a balancing act with respect to a lot of the policymakers that are out there that are pushing agendas that I think are not in anybody's best interest, whether it be the residents or the landlords. So I'm trying to educate them on the space, but at the same time also trying to educate others on what a good landlord is, and almost working on a handbook or a code of conduct. Because what you've seen in some markets and some spaces, there are operators that come in and just are not good actors. And so it gives good operators such as myself, and I think Andrew and others on the call, a bad name. So I just love the business. It is not a get rich scheme. If anybody's on the call thinking, hey, I want to be a mobile home park operator, I think Andrew can attest to it, and others. It's tough business. There are much better and easier ways to make money. And one of the things that I see in a lot of these spreadsheets and IRRs and returns, they look great. But I think at the end of the day, if you want a solid risk adjusted boring return, I think scale back some of your expectations. Think, hey, where can I get a cash flow dividend with the tax benefits that these asset classes offer, with the potential appreciation? If you're looking for high teens IRRs, you know, it's great if they can deliver it. And some of these this in an upward cycle market, I think you can achieve that. But if you really look at it and say, you know, where can I get a 10%? Where can I get 10% of my money? And, you know, there's not many places from a risk adjusted standpoint that you can achieve that. And that's really where I like this asset class is, hey, it affords those types of returns, but at the same time, you can do well by others and provide what's so needed in this environment, which is affordable housing. And so a lot of my time on my parks that I operate is value add opportunities where we can go in, make all kinds of improvements. You know, I just closed on a park in Minnesota, and I think I shared the specs with David. I mean, it looked like parts of it had been through a war zone. I mean, just some of these operators have just totally neglected these things. So it's really just the opportunity to do well.
Wow, thank you. Yeah, thank you guys for being willing to kind of be on the spot there. And you know, I'm guessing we have 5 or 8, you know, professionals on the call here, and I think that's kind of neat because I hope you guys hold us accountable. You know, if you think Mark and I are like blowing smoke or saying something that's too good to be true, I hope you'll raise your hand and make sure that we're not. So thank you. I'm nervous to ask Andrew Keel for his thoughts because I'm gonna have to put a stopwatch on this guy because he might want to take over. But okay, Andrew, what makes you want to buy your next park?
Hey, I really appreciate you guys putting this on. I mean, I would piggyback what Joel said. You know, I think that there's a lot of opportunity in this asset class to take properties that these mom and pops have owned for such a long time, and you know they're living off of these things, so they're not reinvesting when they should be. So I think that there's just a lot of you know, deferred maintenance that we can fix. So it creates a win-win for the residents and for the investors. And I think that's what's really cool about it is that, you know, yeah, we can provide good returns, but also we're improving these assets by implementing the professional management. So that's what I'd say.
Thank you. So Mark, I got a little tracking mechanism on these guys, and so when they get their next investor commitments, we're gonna get 1.25% on their capital raise too. No, I'm just teasing. Just teasing. Anybody have any more questions you want to ask? You know, while we're together. Mike, you got something you want to say?
I hear Andrew really enjoys Snowy Mountain Road driving.
Oh, yeah. We can. If people want to hang,
that's a story for
another
time.
Afterwards, we can get into that after we're all done here. So, any other questions, guys? So David Hawkins asked how long it'll take to deploy the capital. So if we're able to raise, you know, $2 million in the next 30 days, you know, when do you think that'll all be deployed?
Yeah, I mean, we're hoping to do it quick, guys. Again, we create the fund around the deals, not the other way around typically. So we're going to start investing next week and probably do little tranches every week for the next just month or so, depending how money comes in. And the deals as well. And so I'm trying to see if we can do it quickly. That's the whole point, right? Get it to work, get it performing, get it to start earning a return. It's not easy. I got to be honest with you. There's so many moving parts with different deals and different terms, but that's what we do. And so we're trying to get it done 30, 60, 90 days, we'll say, you know, maybe sooner. We don't know, but that's kind of what I would think still is a pretty short window for a diversified fund and a portfolio. A lot of times these funds, you know, we've seen a bunch of them, they'll be open for 2 years. And so we're trying to keep it small, boutique, and, you know, get in the market pretty quick, generally speaking.
Okay. And
David, how do we get the PPM information then?
Yeah, you can just email myself or David, and we can share it directly with you via email.
Okay, do we have, Mark, do we have your email?
You know what, let me just pull it up here, guys, and I can see if I can make this work again. Here, 1 second.
And like the, you know, the emails that invited you guys to this, those have, you know, links and to Mark's, you know, webpage and the fund webpage and thing also. And then of course, you don't know how to get a hold of me. But obviously you learned tonight that Mark's the mastermind here. I'm just kind of helping him get the word out, and grateful to be able to do that. I
Just
had,
get this to pop up, guys. Sorry, Zoom's fun. Okay, here we go. Can you see it there now or no?
yep.
All right.
Mark, how about, so if people invest in the month of March, like how many quarters until you think they could expect, you know, hopefully expect a distribution?
Sorry, I was just trying to figure this Zoom out. So say that again, David.
Oh, sorry.
You know what I'll do, guys? I'll just put my email in the chat box. I think I can do that. Yeah. And then while I'm doing that, David, you go ahead and repeat. Sorry about that.
Just, you know, how many quarters after the investments are drawn in March do you think till there's hopefully a first distribution?
Yeah, so we're saying plan for the end of Q3 2021 for the first distribution. It might be sooner. We don't know yet, but we want to be pretty conservative, and you know, we tend to try and hit what we're saying we're going to do. So.
Okay.
So David and Mark, is that a cumulative preferred return then?
It is cumulative. So if in the first few years we're below the 8 or the 7%, we owe you the difference in the following years.
And is there any interest component to that at all?
It doesn't compound. No, it's just a straight cumulative return.
Okay, thanks.
Sure.
Anybody else have any questions you want to ask tonight? If not, just sure I'm grateful that so many of you joined us, and looking forward to hearing from you. Feel free to contact me or Mark, and you know, we'll roll. So thank you very much, everyone.
Thanks, guys. Appreciate it. Feel free to reach out with any questions. Happy to help.
Bye-bye.
Thanks, guys.
Thanks, David.
Cheers.
Thank you.
Great job.
Thank you, David.
Thanks, David and Mark. Great job.
Thanks, David.
My pleasure. Thank you.
Good job, guys.